What is a stock? Explained simply. If you're new to investing, one of the first words you'll come across is stock. But what exactly is a stock? Where does it come from? And why should you care? In this video, we're going to answer all of that in the simplest way possible. Let's start with a simple example. Imagine your friend starts a pizza business. The business is doing well, but he wants to open more locations. To do that, he needs money. So he comes to you and says, "Give me £1,000 and I'll give you 10% ownership of my business." You agree. Now you own 10% of that pizza business. If the business grows and becomes worth £20,000, your 10% is now worth £2,000. You've doubled your money. That's essentially what a stock is, a small piece of ownership in a company. What is a stock exactly? A stock, also called a share or equity, is a unit of ownership in a company. When a company wants to raise money to grow, instead of just borrowing from a bank, it can sell small pieces of itself to the public. Each of those pieces is a stock. When you buy a stock, you become a shareholder, a part owner of that company. You're entitled to a portion of its profits and a say in certain company decisions. Why do companies issue stocks? Companies issue stocks to raise capital. That capital can be used to hire more staff, develop new products, expand into new markets, or pay off existing debt. It's a way for businesses to grow without taking on traditional loans. The process of selling stocks to the public for the first time is called an IPO, an initial public offering. This is when a private company becomes a publicly traded company, and anyone can buy its shares on the stock exchange. What happens when you own a stock? When you own a stock, two things can work in your favor. First, the value of your shares can increase over time as the company grows. This is called capital appreciation. If you bought shares at £10 each and they're now worth £25,000, you've made a profit of £15 per share. Second, some companies pay dividends. A dividend is a portion of the company's profits paid out to shareholders, usually every quarter or every year. It's like earning passive income just for holding the stock. What are the different types of stocks? There are two main types. The first is common stock. This is what most investors buy. Common stockholders can vote on company matters and receive dividends, but they're last in line if the company goes bankrupt. The second type is preferred stock. Preferred shareholders receive dividends before common shareholders and have priority if the company is liquidated. However, they usually don't get voting rights. Can you lose money on stocks? Yes, absolutely. If a company performs poorly, its stock price can fall below what you paid for it. If the company goes bankrupt, you could lose your entire investment. This is why diversification, spreading your money across multiple stocks, is so important. How do you actually buy a stock? You buy stocks through a broker. Today, this is easier than ever. Apps like Freetrade, Trading 212, or Hargreaves Lansdown in the UK allow you to open an account in minutes and start buying shares from as little as £1. You can even buy fractional shares, meaning you don't need to buy a whole share of an expensive company. Final thoughts. A stock is simply a piece of ownership in a company. When that company grows, your investment grows with it. It's one of the most powerful tools available to everyday people for building long-term wealth. The key is to start learning, start small, and be patient. Wealth in the stock market is built over time, not overnight. If you enjoyed this video, hit like and subscribe to MarketIQBasics. Every week, we make the world of finance simple, clear, and accessible for everyone. See you in the next one.